Hi, welcome to the Baker Borer Monthly Market Update. I'm Ted Cohan, one of the Senior Portfolio Managers here at Baker Borer Bank. What I'm going to be talking about this month is, as we just finished the second quarter, we're going to do kind of a review of the first and second quarter on the indexes for both the stocks, U.S., international, and also the bond market. The first thing I want to do, though, is kind of talk about indexes and which one I'm going to be talking about today. Some of the most common indexes, if you look at like CNBC or Bloomberg or a lot of other financial channels, you're going to hear about is the Dow Jones, the S&P 500, and the NASDAQ. And there's nothing wrong with any of those indexes, but we just don't think they're the best index to look at when you want to see how the overall market has performed for the U.S. So the Dow Jones only has 30 names in it. And what it has is really the 30 of the biggest names out there. So 30 of the big, what we call kind of mega cap stocks. So it's just not a good diversification of the market. S&P 500 is a little bit better. As the name says, it's 500 different stocks. But again, it's mainly large cap and mega cap. And then the NASDAQ has even more stocks. It has well over 1,000 names. The issue there is that it's really heavy in the tech stocks and then also so very heavy on the growth side. So the one that we use that we think really kind of shows overall how the overall market has done for the U.S. is the Russell 3000. And it has 3,000 names in it, just like the name would imply. But what it has is it has those mega cap names, large cap, mid cap, and small cap. So you get really good diversification for size of companies. And then it also has a good mix of value versus growth. So you really get a good feel of the market. The international side is a little bit more kind of standard. The MSCI developed countries X the US is really the main one for developed international countries. And then you have MSCI emerging markets or MSCI EM for the emerging markets countries. And then on the bond side, the Bloomberg US Aggregate Index is really the main one that people use to see how is the US bonds does. So now that we know what indexes we're talking about, the Russell 3000 for the US has had a really good first 6 months. It was up 10% in the first quarter of the year. Second quarter was still good, not quite as good, up 3.5%, so up about 13.5%. The MSCI, the developed ex-US, was up about 5.7% in the first quarter, pretty much flat for the second quarter. A lot of volatility, but ended up pretty much flat for that second quarter period. So it's up just under 5.8% so far for the year. The MSCI emerging markets was up about 2.3% in the first quarter and about 4.4% in the second, so we're up about 6.7%. So really pretty good performance across the board on stocks. Earnings have continued to come out pretty strong. Unemployment has remained low, and so those have been good things kind of driving the stocks. We did see a really uptick in volatility in the second quarter. We saw some big swings up and down, so we saw a lot more volatility. Looking forward on the stock side, we do expect that volatility to continue. What we're still waiting to figure out is the Fed and when is the next rate change going to be. We're pretty sure it's going to be a rate cut. Expectations are right now there's probably going to be one rate cut later in the year as current market expectations, and then maybe a few more into 2025. Still also trying to figure out, is the Fed able to maneuver a soft landing, which seems to be the market expectation now. And then, of course, we have the election coming up in November. Typically, election years add a little bit more volatility, and usually that volatility does spike as we get closer. So typically late September, October, as you get closer to that November election, you get even a little bit more volatility. So we are expecting volatility to continue on the stock side. On the bond side, so far on the aggregate index, where we are is the first quarter was down about 0.7%. Second quarter was pretty much flat, so we're still down about 0.7% for the year. And really the main reason for that is kind of going back to that Fed conversation that we've talked about over the last few months. Again, coming into the year, the expectation was several cuts on the Fed. Inflation really hasn't come down as much as the Fed would like. So they said they're going to be, again, more slow at bringing down those rates. And what's happened is the 10-year Treasury, which is kind of the main driver of rates, has gone from a little bit under 4% at the beginning of the year, spiked up to over 4.5%, and now has come back just below that 4.5 figure. And anytime rates go up, current value of bonds go down a little bit in value. And so that's why we've had a little bit of a negative return on bonds. We still do like the outlook for bonds going forward, because again, what we're expecting is later in the year, Fed to actually start cutting rates. And then in 2025, that'll get a little bit of price appreciation, and you're getting a pretty good yield on bonds. So even though bonds have had a tough first half of the year, we still think they're worthwhile to have. And the other key, again, is going back to each individual person, looking at that asset allocation and sticking with that for the long term, not making changes just based on what's happening for the short term. So that summarizes this month's market update. As always, if you have any questions, feel free to reach out to your advisor. And if not, we'll be back next month with the next update. Thank you.